Hi, how are you? How's everybody? Hello.
Hi, Professor.
Hi, how are you? I just had to make sure, because sometimes there's no way I can tell if my microphone is working or or my headset is working. Although I'm trying to check it from here, looks like my microphone is, yeah, input is through the microphone and output is through the headphone. So, okay. So that, alrighty. So let me. There will be a slight. Okay, there will be a slight change in the layout. As I'm switching. Actually, I'm now switching to. What's okay? More space here. Okay. Uh, uh, all right. You see, that's what I'm talking about. When I when I open the lid of the laptop. So where am I? Okay, so yesterday uh, we did inventory estimation yesterday, right? We did this example, and someone asked me to go over, let me do that after, okay, so what I need is that. This is the assignment. Okay. Oh, this is three. Okay, homework three. So let me go back. I go to finance 100. Okay, so I'm gonna go over homework four a little later. Uh, and I just realized that the instruction didn't go out. I thought it went out, but it didn't. Uh, it didn't go out actually. So I sent it out again yesterday, late afternoon. Um, oh no, this is not your class. What am I looking at? So this is not your class, but 150 is your class. Assignments and oh, no, announcements. Um, so it went out. Both went out. Homework four and homework five. Homework four, because of the time constraint, we have only one more class left. So everything has to be crammed in. There's no other way. So homework four is due this Saturday, and then homework five will be due Monday, right? And these are the homework problems. Someone asked me if all of that screenshot is no. This 8-2 8-2A, I believe, 8-2A. Don't do 8-2. No, maybe 8-2 is also, yeah, 8-2 and 2A. right? Be very thorough. Okay, some people don't pay attention, but so it is clearly saying 8-2 and 8-2A, and they are both, part 1 through 4. So then, if you have the textbook, you can, look it up. But I provided the screenshot. Um, so yeah, they are, and it's really not that difficult. It's just a lot of. This is what I call fat. It's just a lot of fat, right? A lot of verbiage. Verbiage is fat, but actually it can be just uh, crystallized into a, or it can be summed up really in a very uh, concise way like this. It can be summed up, right? So the ability to um, cut through the fat and cut through the verbiage and being able to identify uh, the nits and grits only, right? Nits and grits only, right? The lean, mean, nits and grits only. That is the ability, right? That's the uh, reading comprehension ability, but that's clearly intellectual ability. If you have to read everything and still trying to figure out what that means, that's really poor ability in reading comprehension. But you need to identify what are the relevant variables. The name doesn't matter, right? Doesn't matter what but what matters is something is $800, but that must be the cost, right? That's the cost. A stereo for 800. So C, markup rate based on selling price, based on selling price. So um, you can place it, okay, cost here, $800, markup based on selling price. You put that markup rate here, right? And so on. So I'm not going to go. So, and then, so do the ones that are indicated here, and then A3A, 1 through 2, 8-4A, and then 18A, 18-2A, number 1 through 4. So it's all there, right? 1, 18-1 was there. Was it there? Yeah, 18-1A. I mean, if it wasn't there, it wouldn't be here, right? Okay, and that we're gonna talk about that today. This 18 chapter 18 materials. So so before we do that, let me. So we did inventory estimation yesterday. Um, and then, so we're done with the inventory estimation. So we're moving on to inventory valuation. Okay. And the inventory valuation is, um, topic 5. Okay. We're going to have to, I'm going to download. I'm going to have to download anyway. This is not very. Where's the. Okay, I'm going to have to download this. And I guess I should. This one too. I'm going to download. Okay. One thing I have to check first is, I don't know why it isn't showing, but markups, inventory estimation, and there is one more. I don't know why this isn't showing that. One more. Oh yeah, here. Oh, what happened? There was. This thing is weird. Break-even analysis. There was break. Oh, here. Why is it? Okay, now break-even analysis. Why is it? You see, the bottom tab. There should be three bottom tabs, and this one wasn't, like that. There, I should. But anyway, now, so let me open. I'll just rename this. Okay. Okay. Um, I think it was this file yesterday. Um, so now we have a pretty good concept of what is markup and how markup rate is, how markup rate can be expressed. I mean, markup rate is expressed as percentage rate based on either cost or based on selling price, and being able to distinguish between the two is very important. That's why I've been telling you to use two-column method. Two-column, right? You have to use two-column, right? One column for cost, markup rate based on cost, one column for markup rate based on selling price. So, and we did those examples yesterday. Now, so we're gonna we need to talk about the break-even analysis here. Break-even, first of all, break-even means break-even by itself is not a very difficult concept, because the word break-even means you are breaking even between the revenue and cost. In other words, the company breaks even. So think about it. You're making a movie, and the movie costs $10 million. The movie cost $10 million. Basically, it's all filming the movie. It's all that is related to filming the movie. Paying the actors and paying the staff, crew, and then um, uh, filming at locations and all those expenses, right? So then if it costs $10 million, then the revenue, in other words, the ticket sale, the sales revenue from the revenue from sale of tickets must be greater than 10 million, isn't that right? To make profit. But if the revenue from the ticket sale is only 10 million, at that point, the company broke even, or the producer broke even. Producer broke even. In other words, there's no profit. Profit is zero at that point, right? And after, so that's the concept. So in other words, total revenue, we know how total revenue is defined. Total revenue is defined as P times Q, right? But then and you might wonder, why is total revenue equal to total cost? No, most of the times, there is one point where total revenue is equal to total cost. And if it is equal to total cost, then P times Q will be equal to TFC plus AVC times Q, right? Because total cost is total fixed cost plus total variable cost, right? Everyone is okay with this, huh? If there's anyone who's still catatonic, who's still clueless, then I just can't help uh, you know I cannot be helped at this point anymore, right? You should and since total variable cost is average variable cost times quantity, right? We can set them all equal, right? That means why are they equal? Because at break-even point they are equal. Because at break-even point the revenue must be equal to cost, right? That's what the basic concept of break-even. I just explained that using the movie making analogy. So that means profit is zero at that point, right? Because total revenue, by definition, profit is what? Total revenue minus total cost, right? But if total revenue is equal to total cost, then profit will have to be zero, right? So then we can figure out where that break even happens. In other words, in that movie analogy, right? How many tickets do we need to sell? How many tickets? How many? At what ordinal number of tickets? You understand ordinal number, like first, second, third. That's ordinal number, right? 1, 2, 3 is cardinal number, right? The first, second, third is called ordinal because it's about the order. So does the break even happen at 1 millionth ticket or a 500,000th ticket? At what point does it break? What does it happen? So we can find out at what point. In other words, it's quantity, right? How many tickets to sell? That's quantity, right? And how many tickets, after selling how many tickets, do we break even? So that's quantity. So quantity, so we need to rearrange this equation in terms of quantity, right? Of course, Q is the only unknown, right? Q is the only unknown in this equation. The rest of them are known. First of all, P is the price of the ticket, so it's known. TFC, initial investment in this movie, right? And the operating OPEX of this movie, right? Making this movie, OPEX, right? And then AVC, average variable cost, is, let's say like cost per a foot of film, or, there are variable costs, right? The more extras you use, in the movie, right? The variable cost will go up, right? The more hours, extra hours, more, hours you use the extras for the movie, of course, average variable cost will go up. So the average variable cost is known because we know how much, it costs to make one roll of film, or one, yard of, I don't know how they do that, but so then it's a question of, solving for Q. So you collect the like terms, with the same like, variable. Um, so you transpose this to the other side. You move this term to the other side. So then you can factor out the common factor, P minus AVC times and Q. Now this Q, we will label it with the subscript BE, which stands for break-even, because we want to find this break-even quantity or break-even output level. And on the right-hand side, total fixed cost, only the total fixed cost is left. So if we solve this equation for Q, then that is Q, right? TFC over P minus AVC. P minus AVC is what? That's what's called gross margin. Isn't that right? Price minus AVC, that's what's called gross margin. Remember that? Gross profit or gross margin, right? Gross margin is the correct term here because we're dealing with not aggregate concept, but per unit concept. If it is aggregate, then this would be total revenue, and this would be total variable cost, right? So this way, we can find the break-even point. So graphically, it can be explained like this. Total revenue will grow, linearly, right? You understand what that means? It's proportionate to quantity. Isn't that right? We already understand. Revenue is price times quantity. So if price is given, it is the function of quantity. It depends on quantity. Quantity goes up, total revenue goes up. Quantity goes down, total revenue goes down. And it is linear function, right? Which means, it grows by $500 every one more unit you sell. Okay, does everyone understand? Sometimes, some people don't understand at all. If the language is abstract, some people don't understand at all. So here, think about it. What I'm talking about is, if you're Best Buy, and let's go back to that example. In Best Buy, you're selling computer, and the computer is $500, right? And your let's say total value. In other words, Best Buy buys the computer from like Dell or Hewlett Packard, right? And let's say that price is 300. Okay, from Best Buy's perspective, that's the variable cost, because the more, that's AVC. I'm sorry, AVC. So then total revenue is price times quantity, because the more you sell, it goes exactly in direct proportion to quantity, right? You sold 1 unit. You understand what I'm talking about. You sell 1 unit, revenue is 500. You sell 10 units, revenue is 5,000. You sell 100 units, revenue is 50,000. You sell 1,000 units, revenue is 500,000. You sell 10,000 units, revenue will be $5 million. But if you sell 1 unit, 0 unit, revenue is zero. In other words, it is exactly linear, right? It's exactly a linear function. So this is what it means. 0 unit, zero. Total revenue is zero. And for each additional unit, it goes up by $500. And then what about the total cost? We know total cost is the total fixed cost plus total variable cost, right? Uh, so at zero, and AVC is $200, right? I mean $300. That's our assumption. So think about it. If you when you sell 0 unit, when you sold 0 unit, what's your total cost? Hmm? Anybody? If you sold 0 unit, what's your total cost? Hmm? So nobody is saying anything. So I'm not sure if there's anyone here or if anyone is listening. Hmm? I see like 10 people logged in, but actually there's no way I can verify.
Hello?
Tat-
Yes,
Tatiana?
I'm here. I'm just in the hospital with my grandmother, so I'm trying.
Okay, all right. So um, I just want to show you. You might think if you just sign into if you just sign into discussion board, if you just sign into okay, where is it? Today's forum, and then if you're logged into Collaborate, you think uh, that everything's okay. Um, so it's not really like that. Uh, because as far as uh, this will basically be the basis of uh, this will be the basis of uh, attendance. Um, and I see 11 people because it's not 12, includes that includes me, so 11. And then in the Collaborate, right, uh, after the class is over, I can see okay, I can see the report yesterday, right? I see who logged in at what time, and when they left, and how long they were logged in. That's normal. This is normal, right? Because it's exactly by this record. It's 2 hours and 15 minutes. This was 2 hours and 15 minutes. Uh, and then this is not exactly 2 hours 15 minutes, but if you are about 80%, if you because sometimes you get the connection is dropped, So you are dropped out and then you reconnect and all that. Uh, and I can, considering the gap for, while you're disconnected, right? Um, Something like this is quite, plausible, right? And this means, this person connected twice. Yeah, once, you got disconnected and you got connected, you reconnected, and then so on, right? Or during the break, you disconnect, and then, according to this, Shirley connected 3 times, and so on, but pretty decent login time. Everybody was, logged in, for, quite a decent time, yes, but, except for Anoris, who was logged in only 10 minutes 33 seconds, and that even 10 minutes 33 seconds, uh, there were 3 connections, 3 attempts. So I don't know if it was because our connection was bad or I can, but still you can tell, who was connected for how long, right? So if you think, if you are here, um, and there should be some biological signal. I mean, if you're here, some vital sign, biological signal, because if even if I ask a question, nobody's answering, then there's no way I can tell this. Tatiana, you still have a question? Tatiana, your hand is raised. Oh, okay.
Sorry,
So
sorry, I'm
no
already.
problem, no problem, no problem. Okay. I think I'll take it. Uh, all righty. So where was I? I was talking about the yeah. Um, where was that thing? I have 2 open. I don't know. I had. Okay, I'll close one. Let's see if I still have one. Yeah, still one. So graphically, uh, now it's understandable why it is linear, starting from 0. But what about the total cost? When you made 0 unit, what's your total cost? Hmm? When you made 0 unit, a company made 0 unit of this zero computer. What's your total cost? Hmm? No one can answer that. Now, when you made 0 unit, the total cost is exactly the same thing as total fixed cost. Too late. Huh? Sorry, too late. It
Yeah.
should be equal to total fixed cost. Um, why? Because whenever I ask this question, without any exception, I hear the same answer. They all, just habitually, without deep thinking, they just say 0. Well, what's 0? What's 0 is total variable cost is 0. Total variable cost is why? Because total variable cost is AVC times quantity, and if Q is 0, quantity is 0, this whole thing is 0, right? TVC is 0, right? However, we still have TFC left. TFC is a constant, it's a given number because it's a sunk cost, right? That's why it's called, fixed cost. It doesn't change with the production level. So we still have when you don't produce when you produce 0 unit, your total cost is equal to total fixed cost. Think about it. The initial investment in this computer manufacturing business is, let's say, was $10 million, right? That $10 million was sunk into this business. It's sunk into this business. So regardless of whether you produce 0 unit or 1,000 units, doesn't matter. It's still $10 million. So so you already, that's why it's called the sunk cost. You're sunk in, this cost is sunk into the project. You're saddled with this cost, whether you produce or not. So if you already, if you have already incurred this much cost, then the only way out of it is by making the computers and selling the computers and get out of it. But as you make more and more and more computers, right? Now the total cost will go up, starting from this $10 million. That's what we assumed as total fixed cost. And it will increase by $300 per each unit, right? Per each additional unit you produce. This line will total cost will increase by $300. And because they will intersect at some point. Total revenue and total cost will intersect at some point. Why? Because their slopes are different. If the slopes are different, they will have to intersect at some point. Isn't that right? If the slopes are the same, they may not. But think about it. Right? If the slopes are like this, then they run parallel, so they will never meet, right? The slopes are different, so they will meet at some point, right? And the slope is like 500 for slope is for each additional unit, right? The slope is what? Rise over run. So the rise is for each additional run, and each additional run is 1 unit, right? For each additional unit, right? It goes up by for each additional unit, right? It goes up by $500. So the slope is 500. For total cost, slope is $300 because for each additional unit, it goes up by 300. So they will have to meet at some point. And this point, they generally call this break-even point. But yeah, you can point to that. You can point to that if you graphically represent it. If you draw this graph, you can point to that point. You can point with the finger, right? Or arrow. You can point to that and call it break-even point. But actually, if you do not use any graph, how would you express that point? If you do not use, it will have to be expressed by quantity. In other words, how many computers or how many tickets, movie tickets, right, do you have to sell? And what ordinal number of of the unit, right? Is it 10,000th unit or 11,000th unit? At what unit does it break even, right? What quantity or what output level will bring it, will make the company break even, right? So then we all understand at that point, profit is 0, right? That means total revenue is equal to total cost. But before you reach that point, which one is greater? I mean, before you reach that point, profit is negative. Why? Because total cost is greater everywhere, right? Cost is greater than revenue everywhere, right? At every output level, total cost is greater than total revenue. And then past that point, right? At every level, at every output level, total revenue is greater than total cost. Hence, profit is positive. Okay? And that's why we want to find the break-even point, because break-even point by itself is not difficult. Break-even by itself is not difficult. And it's a break-even by itself is not what we are looking for, because what kind of management would just want to break even? Nobody wants to just break even, right? But the reason we are doing the break-even analysis is because once we know the break-even output level, right? Once we know this level, all we need to do is produce above the level, and then we are guaranteed profit, right? So that's why we do the break-even analysis, and so um, so we know, okay, this is the break-even formula, right? Finding break. So let's do some exercise with that. So here, if you go, I think if when you open that file, the third bottom tab will be break-even analysis. The third bottom tab is break-even analysis. So let's do this. In this break-even analysis, first of all, I don't know what kind of product it is. The price is $5. Price is $5, and oops, I cannot even. What is going on? I cannot change that. Okay, so I'm gonna use. I think this is useless, so I'm gonna close this and open it from. So does everyone have this file in front of you? You must have this file in front of you. See, the third tab is here, break-even analysis. And I don't know what it looks like to you, but it should be, all these highlighted cells must be blank. Are they blank?
Yes.
Please let me know.
Yes.
Okay, good. If they are blank, then you're good. It's good. So first of all, so let's turn it into our example. Our example is computer manufacturing, right? So in computer manufacturing, so you're selling the computer for $500, and you are. So if you're Best Buy, it's not going to be you don't have that much total fixed cost because you don't have any plant. But let's say, I mean, even the warehouse and the stores, they must be leasing the store space. But if they, at least a warehouse, I don't know, let's say they have $10 million total fixed cost, and then Best Buy bought the computers from manufacturer at $300. Then we want to know at what quantity level, at what output level we're going to break even. So first, we will complete, we will fill in these by its own definition. First of all, so total revenue is then, it's going to be P times Q. Of course, nothing will show up because Q is P times Q. Oops. Where's P? Why isn't it doing this? Okay. Okay. Oh, no wonder. I see. So obviously, because Q is 0, there's nothing. Now, TFC, this doesn't need to be repeated here, but I'll just, TFC is there. TVC, by definition, is AVC times per unit production cost times quantity. Okay, so nothing is there, but it will show up when we find this. So total cost is by definition sum of these two, right? TFC, right? And TVC. Profit is by definition total revenue minus total cost. Okay, and right now it will show as negative 10 million because you have 0 total revenue. Now we're going to find break-even quantity, and which will be what? TFC over P minus AVC. Okay, and this P minus AVC, in some books they call it contribution margin or something, contribution margin. But that's gross margin, actually, if you think about it. The term that you've learned so far, from the terms that you've learned so far in the income statement, that's called gross margin. Okay, you hit enter. It says 50,000 units. So think about it. Is it correct? At 50,000th unit, we will break even because profit is 0 at that point. Because profit is 0 at that point, right? Okay. So this is how we find break even point. We can also do some target profit analysis. I mean, if $10 million is our target profit, then how many units do we need to sell in this type of analysis, right? But we're not going to do that now. So let's just do it slightly. Let's tweak it a little. I mean, this doesn't look very realistic, so let's try some realistic example. So let's say we are selling something for $87. I don't know, textbook, right? Some textbook. A cost per the book is, let's say, 65. And if total fixed cost is like, I don't think the publishing, textbook publishing would require this much. Okay, that's not likely. Maybe we'll bring it down a little. We'll whittle it down to something like $2.5 million, right? 2.5, not 55. So 2.5 million, and if that's the case, we will have to sell 113,636. Actually, 637 volumes or units, right? If you're talking about textbook, right? We have to sell, or copies, right? 113,637 copies to break even. And if you sell more, then profit. Why 37? Because why? Because think about it. You cannot sell 0.36. How can you sell 0.36 book? How can you sell 0.36 copy? Right? When you sell a book, it has to be a whole copy, a complete copy, right? Suppose this is a car, right? Tesla, how much is Tesla? I don't know. Let's say Tesla is uh, uh, the cheapest model. I don't know, maybe 45,000. 45,000. And Tesla's, uh, uh, initial investment must be something like uh, at least 72.5. It would be more, like a billion, in the order of billion. Let's say 1.725 billion. Not this is not billion. Yeah, it's still 172. So I'll give it one more zero. One more zero. So if 1.725 billion, and the average variable cost of production uh, per vehicle, let's say 22,500. Let's say, if that's the case, it will give us again instantaneously. They have to sell at least 76,667 cars. You cannot sell 0.67 car. You cannot make only you cannot make a 67% of a car and sell it, right? Makes sense. That's why you have to round it up. Now, if this is something like a liquid, or if it is cheese or milk, right? Something that is sold, I mean, it can be like that, because you can sell 76,666.67 gallons to break even. I mean, that's possible, right? If it is something like grain, salt, all possible. But if it is an industrial product, right, it has to be in a whole of form and shape. You have to round it up, right? That's basically how you do the break even analysis. Okay. Uh, All righty. So I think it's a good time to take a break at this point. It's almost 4 o'clock, so we'll take a 10-minute break and come back at like 4:10. Okay. All righty. Let's take a 10 minute.
Professor?
All right, we're back. We're back. So,
Hey, Professor, I'm sorry to cut you off. I came to class late. Is
mhm.
that okay or?
Well, as I said, as long as you have, as long as your logged in time is at least 80%
Right.
of the class time, you're marked present. So present is 0.25 points, but if it is
Okay.
less than 80%, that will be considered late, and late is 0.1, right?
Okay. Right.
Okay,
Okay.
okay. But I guess generally, I don't think you have had a good attendance record as far as I remember. So I think it won't really affect. I mean, the impact is only 0. If you're late, then the impact is only just 0. I
Zero
mean
point one.
0.15
Okay.
less than present, right?
Okay.
That's
Okay. No
just it.
problem.
Okay,
Okay.
all right,
All right. Thank you.
all righty. Mm-hmm. Where am I? Where was I? So now we're about to move on to the next topic. The next topic is inventory valuation, right? I remember we did inventory estimation uh, just a while ago, uh, and I think I have already opened this. I don't. I did. I'm opening it again. I should just okay. And inventory valuation. How is it different? I mean, how are they different? I mean, previously it was inventory estimation, right? And inventory estimation is basically estimating CGS or ending inventory based on cost ratio, right? Or markup rate. Now, inventory valuation is uh, basically valuing. It's also estimation, but valuing inventory based on LIFO, FIFO method using ending inventory. So we're gonna go about that now. But I'm I'm showing you this because this is clearly mentioned in the homework instruction. Uh, I don't know. People don't read the instruction. People, that's the thing. If you don't read instruction, then um, and then later, all kinds of confusion arises because you don't. Some people don't read instructions. So let me go back. Let me go to. So this is homework 4 instruction, and it says do this, blah blah, do this. So I'm gonna, I will show you what those are, um, and then read thoroughly and closely. One, how to name the file. Two, font rule. Even with this font rule, clearly, repeated every time, some people ignore it. If you continue to ignore it, you will continue to get penalized for that. Those, violations will be penalized. There's no other way. And then format. Uh, Number 4, refer to the last slide of inventory PDF for bad example to avoid, right? Bad example to avoid especially misplacing line item. So please, this is bad example. Please take a good look at it because some people just go to the book and do just what the book has done. But the book is very sloppy about things like, first of all, they think this is, oh, cost of goods. So that must be CGS. No, read carefully. What is it? It's goods available for sale. It's GAS. Some people might ask, then why do they make it so confusing? No, it's not confusing. GAS is GIS is already originally in cost. So of course this is redundant to say cost of goods available for sale. This is redundant. And why do you write out everything? Even in homework 3, it takes me so much time and effort to comment that, don't make the labels wordy, because being wordy labels are simply unprofessional. Wordy labels are so juvenile. But the book, and then they just copy the book. When I give the homework, they just write it out like that. You don't need to write out beginning inventory. You don't have to spell it out. If you just BEGINVT, professionals know what they mean. BEGINVT. What else can it be? That should be beginning inventory. Net purchase is enough. You don't have to say during the month. I mean, what else would it be? Whether it is a monthly statement or quarterly statement, whatever it pertains to, it will be whatever it pertains. The data will be whatever it pertains to, month or quarter. Doesn't matter. Don't spell it out, please. Don't write it out. It's not sharp. First of all, writing out everything is not sharp. Two, when you put it into a single cell, and if it is really wordy, it expands the cell unnecessarily. Then that makes it so ugly. I mean, the whole thing is like an elementary school kid, trying to write an essay. Right? This is so that's quite ridiculous. That's wrong. And also they, and I'm going to come back to this because I don't have time for this. We're coming back to this anyway later. But please pay attention to this when you are, since we are in, so I'm going to know where they belong, know where these data. Okay, since I already brought it up. Okay, take a look at this. Cost ratio. If it is cost ratio, it better be put in the cost column, not in the retail column, not in the price column. Okay, and then they use two column method. So net purchase during the month, in cost, this is the net purchase. In price, this is the net purchase. Okay, so they put it in. It must be a retail business because that's why they express it in both cost and price terms. And less net sale for the month. Okay, it's sales, so it's subtracted here in the price column, right? And ending inventory at retail. So if it is at retail, that's fine. And then ending inventory at cost. This is a stupid thing. Very sloppy and stupid thing. Why? Do you need to repeat ending inventory twice? Here's ending inventory. Ending inventory. It's redundant, and being redundant is being stupid. Being redundant is maybe not stupid, but not efficient. It's not professional. If you're redundant, if anything is redundant, it's not professional. So how do we have two columns. We have two columns, one cost column and a price column. Then why do you put ending inventory at cost here? That's very stupid and sloppy. You don't have to say ending inventory at retail. Just ending inventory is enough. And ending inventory at retail is already put here. If it is put in this column, that's retail price. Ending inventory expressed in retail price. then all you need to do is ending inventory at cost. You don't need to say cost. You use the same row and just this needs to be put here exactly side by side, parallel to this. So that's why we use two column. So they are running so that they will run side by side in parallel. You understand? And this may not look, I made comment there, and it may not look very clear. It may not look because this is too small, but you increase, enlarge, and it will, right? Look at what I'm saying, and read it, and think, and do as warned and cautioned, right? To some people's homework, I comment repeatedly, and still they don't heed the comment. So if you continue to not to heed the comment or instruction, then you will continue to get penalized. Heed the comment, heed the warning. If there's an instruction there, the instruction is to be obeyed, to be followed, to be complied with. And if you do not follow, obey, or comply with the instruction, then it will get penalized. And so some people get penalized that that could have been avoided if they simply adhere to or comply with the instruction. And then I'm sure some people will. There are people who are logged in but never attend the class, logged in but never participate in the lecture, never watch the video, never even I provide a video twice, the pre-recorded and the live session recording. They never watch. It seems like they never watch any of those. That's why they continue to violate all those rules, all those instructions. They violate all those rules and instructions. And then they only will, it's only right that they, be served the consequences, And I'm sure some of those people will still continue to do it this way, like this, even though in the live lecture, in the live recording, I stressed out emphatically, right, bursting my vocal cord. I stressed this point that, this is what you need to avoid, but still some people will just continue to do this. I know. And then, there's no other way. There's no way they can avoid the penalty that fits that violation. Okay, so that's the thing. Again, this is net sales at retail. I mean, this is sales revenue retail. Then which column does it belong to? It doesn't belong in this column. It belongs in this column. But they put it here. How stupid it is. The book is, that's why I don't use this textbook. I use this textbook only to borrow the problems, right? But the methodology they use here, I don't use that at all because it is, substandard. It's really, really sloppy, right? All of these things, I want you to, take heed, right? You must heed. I don't know if they use the word, even understand the word heed anymore. Take warning, take precaution, heed, right? Because it sounds like 19th century vocabulary. Heed, like someone, preacher, holding the Bible in his hand, take heed, the Ten Commandments are saying. So it's some kind of vocabulary that belongs to the 19th century, but still, in But anyway, that was the. So here we're into inventory valuation. And inventory valuation. So let's take a look at the example. Here's the thing. Suppose you're running a sporting goods store, and in the sporting goods store, there may be, there are lots of, sporting goods like tennis rackets, golf club, basketballs, basketball jersey, shoes, a lot of things. But let's say we're looking at the tennis ball. So if you think about it, this is the net purchase section. You remember? Because in the income statement, right? In the CGS section, right? You have beginning inventory, and then there is net purchase, and then it's cost of see, in chronological order, cost of goods sold must come next, and then after that, ending inventory, right? I mean, although in reality, right, they are switched. In income statement, the order of ending inventory CGS is switched. The order is somewhat weird, but I told you there's a good reason why, because CGS is the conclusion. It has to be the conclusion of this section. And we know this is GAS, right? Together as GAS. So we think of net purchase as just a single occurrence, but actually it can be multiple occurrences, right? Because during the first quarter, there could have been January purchase, February purchase, second February purchase, and then March purchase, or whatever, right? The net purchase could have happened at multiple points, and then that causes some problem, or why? So in this example, if it is tennis balls, right? They purchased 430 tennis balls in January. February they purchased 8,450. March they purchased 12,370 tennis balls. But then the unit price per ball, right, tennis ball, consistently increased, and this makes sense. Why? Obviously, first quarter is not really a good example. Maybe second quarter could have been a better example. Let me change this to April, May. This makes more sense. And June. That makes more sense. Why? Because when it is very cold, in winter, who plays tennis? Of course, some people may, but they don't. You don't play tennis outdoors. Tennis is basically outdoor sports. If you play tennis indoors, that's squash, right? But anyway, starting, spring comes. April, more people start to play tennis. So the demand for tennis balls go up. May, it got warmer, more people play tennis, so the demand goes up. So they purchase more. June, more people play tennis, so they purchase more. And then it makes sense why the unit price increases, because as the demand goes up, price will have to go up, right? With more demand, the price goes up. It's natural. Now, then, at the end of the first quarter, there are 4,572 tennis balls left in the ending inventory. That's the ending. That's the meaning of ending inventory, right? Now our question is, so what dollar amount are we going to put on the ending inventory? What dollar amount? What dollar amount? This is a this is a question, big question. Why? Because not all the tennis balls have this. The tennis balls don't have the same price because depending on when they were purchased, right? Depending on when they were purchased, the prices are different, and we don't know from which batch, from which month batch these balls of. It's all combination. It's all a mix, right? It's all a mix of, because we don't know, some of the this April batch didn't get sold, and they got, they remained, right? They didn't get sold, and so they are left in the ending inventory. And some of them may have come from the May purchase. Some of them may have come from the June purchase. So since we don't know how much of that is from each month or each batch, we cannot put a single price on it, and we don't know which. Of course, in the old days, that was a problem. These days, maybe if the tennis balls are still in the cylinder, tennis balls are not sold. They are sold in the cylinder, right? Like 5 balls in a cylinder or 10 balls in the cylinder, and those plastic cylinder, right? Clear plastic cylinder. I don't know if they still sell it like that, but I'm sure. And the cylinders will have barcode on it. You will put a barcode in. So if they are still in the cylinder, and if it has barcode, you can scan the barcode, and you can trace it back to when it was purchased, right? But let's say there's no barcode. I mean, no, these tennis balls are not in the cylinder. They are in bulk, or and in the days before barcode, then this is a real problem. You cannot trace it back to, unless you mark each hole, and it's going to be a huge, labor-intensive job, requiring a lot of man hours to actually, trace it back to, so to simplify that, they came up with three techniques or three methods. First one is weighted average method. Second one, FIFO and LIFO. So FIFO means first in, first out. So that means whatever came in first is assumed to have been sold first, and LIFO assumes whatever came in last is assumed to have been sold first. But that's unnatural. But we're gonna come. Weighted average means okay. So first you might think, oh, what if I use the average? Again, maybe not in this class, but I always in finance class we make clear distinction between weighted average and simple average, right? And simple average versus geometric average. But here, you might think, oh, so I'm going to add them up and divide it by 3. So I'll use that. No, that's called simple average, and it is no. You cannot. Why? Because their proportions are different. Their proportions are different, right? In other words, you cannot treat the same because their weights are different. Their weights. You understand? So then how do we do that? You will need to reflect that weight, right, in valuation of valuation of those, in that inventory. So that means, okay, what is the total amount of this? In March you bought, right, 5,430 at 68 cents. So the total amount in March, purchase amount, total, April, the inventory was like that, and you can just drag it down. Every month is going to be pretty much the same thing. And then I'm going to find the sum of all the quantity, all the units, right? Which you can do simply by using AutoSum. I'll use, there's AutoSum, and it's going to automatically find sum. And I'm going to do the same thing here, AutoSum. Okay, total amount. So let's do this. Total amount divided by total quantity. Total amount, total inventory, dollar value of inventory, total dollar amount of inventory divided by inventory. Okay? And then, that makes sense. Now, that's weighted average. That's weighted average. Okay? So all different proportions, all different weights are reflected in the total amount, and it is divided by. So it's think about it. If you took simple average, right? Just just for. If you do that, it will come out as 70 cents, but that's not right. Yeah. What did I do? Right? That's not right. We know there is a difference between simple average and weighted average. So once we found the weighted average, then we'll apply that to ending inventory, whatever is left in the ending inventory. Okay, then our ending inventory value is 3,224. Now, so why do we do this? Now, this will, if we know the ending inventory, then we can guess, we can estimate true cost, true CGS more easily, right? We can estimate true cost more with more confidence, right? And once again, why do we want to do that? Oh, if you are the company, if you're the one, if you're the this company person, you don't you don't need to do this. If you're the company insider, you would know the true cost. But as I said, outsiders don't know the true cost. And honestly, as a client, I would, as a customer, I would like to know the true cost. For example, why is iPhone so expensive? I want to know the true cost. They will never tell you the true cost, because if they tell you, then everybody will feel that they've been cheated, right? I mean, true cost is only $200, and why is it selling for $1,500, $300? They are price, basically they are price gouging or profiteering, And of course, IRS wants to know the true cost too, right? Competitors want to know the true cost too, but most of all, IRS would have IRS has a very good reason, huge incentive. IRS will have a huge incentive to know the true cost. Second technique is called FIFO. So that means whatever came in first, right? First in, first out. whatever came in first sold out first, got sold out. It went out, right? It sold out first. So then what does that mean? Oh, whatever is left in the ending inventory didn't come from the didn't come from the first month purchase. Isn't that right? Some people, this is very shallow thinking. Because, if they cannot do deep thinking, then they just always their thinking is so shallow. They think, oh, the first in first out. So okay, I will first in first out. So this is the price I'm gonna have to apply. No. This is the price you'll have to apply. Why? Because the first the inventory that came in first, they got sold, so they are not there anymore. Right? What got sold is part of CGS, not part of the ending inventory. And whatever is in the ending inventory is what's left unsold. So then, the price would have to, then if it is from, that must be from the last batch. It must be from last batch. That's the assumption, right? So what we need to do is then, okay, you might think, okay, so this we will apply the last purchase price, last price from the last. Yeah, that's right. Eventually, if it is, but then you have to also consider. Let's think about this case. In this case, we know the drill. It's not difficult. Using using first weighted average. Just we'll just drag it down. And use auto sum. And then weighted average is this. Okay, all right. And then weighted ending inventory valued by at weighted average is this times this. Okay, that's fine. But then here we have a little issue here. So if we use FIFO, then if we use FIFO, there's 13,450 units in left in ending inventory, but the last August purchase was only 12,673. So that means what? This ending inventory couldn't have come entirely from August, right? Makes sense? Part of it came from August, right? And the remainder came from July, right? Makes sense? So in other words, entire August purchase is left in the ending inventory, and then the difference came from July. So you can do, okay, then I will multiply this thing by August price, and then take the difference between this and this. So that difference will be whatever the difference will be, and that will be valued at July price, right? Okay. Okay. Now we can handle it. But then, the problem is then in the previous example, we were lucky that our ending inventory was below the June quantity, June purchase quantity, right? But what if it was like this? I mean, there's no guarantee it will always be like this. What if it was like, second example? In the second, so do we, in other words, in the second example, we had to make adjustment by ourselves, right? Or, for ourselves. Um, and then the question arises, so do I have to be there every time? And do I have to be there every time to make sure that, uh, uh, this ending inventory, whether this ending inventory is greater than or less than the last purchase, or and if it is not, do I need to make that do I need to make that adjustment every time? Yeah, that is the problem. If I have to make that adjustment every time, in other words, if there has to be human intervention every time, what's the point of using Excel? What's the point of using the computer? Right? You understand? Huh? I don't want to. What I'm trying. Hide. So in other words, I don't know why it isn't. So I'm gonna move it. Okay. Um, the reason we are using Excel is to automate all this process. To automate the process, then, uh, so we want to automate the process so that we don't have to be there every time. So then, how do we do that? So I'll do it like this. You remember the if command? Remember, right? It. I told you, if command will come in very handy. So first of all, we'll do this. If this ending inventory is that's Q4. If this ending inventory is less than um, June purchase, then all you need to do is, it's simple. You're going to do uh, Q4 times June price, which is M5, right? Okay. And I told you second comma is otherwise. Otherwise, then what do you need to do? Otherwise, then what you need to do is June quantity must be valued at June price plus the difference between this and this, right, will have to be valued at May price. Okay? So otherwise is the opposite case, and in that case, this ending inventory will be greater than this, so uh, it will do that. If it is not, it will do this. So if you do it like that, it's gonna hit OK. Nothing changes here because it satisfies the condition. But here, I'll copy this. paste it there. What do you see? Of course, it's the same number, but Excel automatically picked it up, right? So if L11 is, if L11 this, if L11, I'm sorry, Q10 is less than L11, right? Then just, Q10 times M11, that's it. But then second comma, otherwise, but, of course, the first condition is not the case. So it will, Excel will automatically pick up the second condition. Otherwise then this times, it will be this times this, and then the difference between the two will be valued at this. So Excel automatically does that. Okay. So then, by the same analogy, right, we will also use if command for LIFO. LIFO means last in, first out. So whatever came in last got sold first. But this is, unnatural, because how can the last, I mean, what happened to the first batch, first purchase? What happened in the meantime? I mean, why didn't they get sold? It's possible. I mean, in the first batch, when you bought this thing in April, that was already, out of fashion, or, especially if it is fashion industry, right? Garment industry, it can happen. What you bought in April, you bought that in April, but it wasn't really, it was already, falling out of fashion. I mean, so then it's very slow. It's not getting sold. May, similar, but June, now the June purchase, this is a hot item. This is, this is in vogue, right? It's very catchy, it's very fashion. It's in fashion. I mean, it's what should I say? It's trend. It's in trend. So it gets sold. And the apparels that were bought in April, they were not, in trend. So they were not getting sold. But finally, in June, you were just getting rid of them by putting them on a fire sale, whatever. But anyway, the idea is, okay, then if this is less than June purchase, right? All you need to do is, because it's last in, first out, whatever is left, I'm sorry, if that is the case, we're talking about LIFO, so if it is less than this, right, then Q5 will be valued at April price, because whatever is left is from the earlier purchase. And then Q5, okay, and otherwise then you're gonna do the entire L3 by M3 plus the difference between the ending inventory and April purchase will be valued at May price. Because whatever is the difference, it should be. But it's not going to happen in this example because the ending inventory is smaller than April purchase. So we hit enter. Yeah, that's going to be the case. And then, but it will be the other way around, right? So if this is less than, if ending inventory is less than June quantity, right? June purchase, then no problem. You'll multiply this by June price, right? Q11 times M9. Otherwise, June quantity will be valued at June price plus the difference, right, will be valued at July price. Okay, then you get this. And what do you observe here from this example? What you can observe from this example is that this thing is weighted average, right? Average means average cost weighted average. You see, the price is consistently going up, right? I mean, price going up for 3 months is not really, cold inflation, just 1 quarter, right? And just, sporting goods, tennis balls, not. No, across the entire economy, gas price goes up, food items go up, everything goes up. That's inflation, but and it has to be, like consistently, a quarter after quarter. But this is not. I don't know. I mean, one of the reasons that the price is going up is not only probably due to inflation. I mean, if it is not happening only in a single item, right? The tennis balls. What you can see is when the price is going up, right? When the price is going up, FIFO will make the ending inventory. LIFO will make the ending inventory the smallest. When the price is going up, LIFO will make the ending inventory smallest. And if ending inventory that's important. Why? Because if ending inventory is smaller, that will make CGS look bigger. Right? You understand? And why do you want your CGS to look bigger? I mean, you don't really want you might wonder, why do we want our cost to be bigger? No, you don't want your cost to be really bigger. Right? You don't want it to be really bigger. You just want it to look bigger than it really is. You understand? Why? Because if the CGS is bigger, then EBIT will be smaller. Anything that makes the cost look bigger will make the EBIT look smaller. Right? So CGS can be I don't want to call it manipulated. I don't want to call it a manipulation. But this is, I mean, if you call it manipulation, yeah, but this is totally legitimate. This is legit. Why? Because this is what the accounting practice, this is allowed practice in accounting. And, GAAP, this is according to GAAP. So IRS won't, have problem with that. The only thing is that if you're using LIFO now, that means FIFO will be more favorable when there is deflation, right? When there is deflation, FIFO will be more favorable. But then you can't just switch like that. Oh, because now we're in inflation, we're under inflation. We're gonna use LIFO, and then when we have deflation, I'm gonna use no, you cannot switch like that. Okay, you can switch once, but you cannot switch frequently, right? You may switch once in 10 years, but not frequently like that. Okay, so FIFO LIFO will make your CGS look bigger or smaller than it really is. And then OPEX, operating expenses, it can be made bigger or smaller than it really is. It will be bigger than it really is thanks to depreciation. Okay, so in both CGS and OPEX, there is some latitude, I mean leeway or room for making actual expense look, making the cost look bigger than it really is. Okay, and that way, EBIT gets smaller. If EBIT is smaller, EBT will be smaller. If EBT is smaller, the taxes will be smaller than it really should be. And you might think, well, isn't that tax fraud? No, this is not tax fraud because this is a legitimate accounting practice, legitimate accounting technique. So this is LIFO, FIFO, and there is here's more complex example. We're not going to do complex example because this complex example here, I'm using. You will see, a nested loop. In other words, a loop in the loop in the loop in the loop. Like what is that? The Russian doll, right? Babushka, or what I'm talking about, the Russian doll, right? You open that doll, there's another doll inside. You open it, there's another doll inside. Open it, another doll inside, right? The Russian doll, right? Just like that. It's called babushka or babuska or something. It's the same concept. You embed if statement in another if statement, and which is embedded in another, right? If statement, which is embedded in another if statement. It can go, but think about it. It may look very complicated, but maximum is like maximum layer is 12. Why? Because it cannot exceed 1 year. Everything has, so the maximum layer will be at most 11, 12, right? A layer after layer. But you don't have to. We don't have time for that. So basically, that's all the time we have today, right? I hope you have, carefully. I'm gonna also post this video, this recording of the live session, and some that never really participated in class. At least I want them to watch that because I know some of you will still give me the wrong, despite all that warnings, still give me the wrong homework because I talked about this, right? Bad example. Someone will still follow the bad example because they are not listening, they are not watching, they don't participate in the collaborate session. They just log in and just go away, do whatever, then it all comes back upon you. It comes back to you. You have to understand that. The consequence of that, the consequence of your negligence will come back. You may have some reasons why. You may have good reasons why. But if you are, when you are, a student and taking a class, I mean, your goal is to your goal must be not just passing, but passing with flying color. And if if you want that, you cannot ask for A if you are negligent in class. It is directly proportional to the effort you put into it, right? Alrighty, so that's it for today, and oh, I think it's frozen. Uh, but that's it for today. Okay. Come on, where is the mouse? So I will see you guys on Monday. Please remember, uh, homework 4 is due. All right, please uh, have a great evening, everyone, and I will see you on Monday, the last day. Okay? Take care now. Bye bye. I'll stop recording.